A trading account loses 20%. How much does it need to gain to return to the previous peak? Not 20%. It needs 25. If it loses 50%, the required recovery is not 50. It is 100%. This is the drawdown trap. Losses and recoveries are not symmetrical, and the gap becomes much more severe as risk increases. In this video, we will turn that simple fact into a practical framework for evaluating an expert advisor, sizing trades, and deciding when to stop before a temporary setback becomes a survival problem. Drawdown measures the decline from a previous account peak to a later trough. If equity reaches $10,000, falls to $8,000, and then climbs to $9,000, the drawdown from the peak is still 20% until that old peak is recovered. This is different from asking whether the account is above its original deposit. A strategy can be profitable from day one and still be in a serious drawdown from a newer high. The reference point moves upward with each new peak, which is why peak-to-trough tracking matters. The recovery calculation is straightforward. Divide the drawdown percentage by 1 minus the drawdown percentage. After a 10% loss, 90% of the capital remains, so the required return is 10 divided by 90, or 11.1%. After a 30% loss, 70% remains, so the required return is 30 divided by 70, or 42.9%. The formula is not a market forecast. It is pure arithmetic, and it explains why at small drawdowns, the recovery gap looks manageable. A 5% decline needs about 5.3%. 10 needs 11.1, but the curve soon bends upward. 20 needs 25, 30 needs 42.9, 40 needs 66.7, and 50 needs 100. At a 60% drawdown, the account needs 150% just to break even. This nonlinear curve is the first reason I do not judge an EA by net profit alone. A large return can look attractive while the recovery burden remains hidden. MetaTrader separates balance from equity. Balance reflects closed results. Equity also includes the current floating profit or loss of open positions. That difference can be critical. A grid or averaging system may show a smooth balance curve because losses have not been closed, while equity sits far below it. MetaTrader testing statistics track both balance drawdown and equity drawdown for this reason. When I review an EA, I want to know what the account experienced while trades were open, not only what the balance showed after positions were finally closed. Imagine two systems that both finish the year up 30%. System A reaches that result with an 8% maximum equity drawdown. System B falls 35% before recovering. The final return is identical, but the experience is not. System B required a 53.8% recovery from its trough, and many traders would reduce risk, interfere with the system, or stop it near the worst point. The path affects survival, behavior, and the chance that a real account will remain active long enough to see the advertised result. A backtest maximum drawdown is the worst decline observed in that specific sample. It is not a guaranteed upper limit for the future. The next losing sequence can be longer. Spreads can widen. Slippage can increase. Several strategies can lose together. Even a clean test is only one ordering of trades under one set of conditions. I treat historical drawdown as evidence, not a safety certificate. Before live deployment, I ask what happens if the real drawdown is 1.5 or 2 times the backtest number, and whether the account can still follow the plan. Fixed percentage position sizing automatically reduces the dollar amount at risk as equity falls, but the chosen percentage still matters. After 10 consecutive losses at 1% risk per trade, about 90.4% of the account remains. The drawdown is roughly 9.6%. At 5% risk per trade, only about 59.9% remains. That is a 40.1% drawdown, requiring about 67% to recover. The losing streak is the same. The survival burden is completely different because the risk setting changes the compounding path. Traders sometimes treat lot size as separate from strategy quality. In practice, risk changes the strategy experience. The same entries and exits can produce a tolerable drawdown at one size and an account-threatening drawdown at another. Higher risk also changes behavior. A normal losing streak feels abnormal, the temptation to stop grows, and the next trade becomes emotionally heavier. This is why a backtest made with 0.01 lots does not prove that a much larger live lot is suitable. The logic may be unchanged, but the account path and decision pressure are not. The most dangerous moment often comes after the drawdown has already started. The account is below its peak, recovery looks slow, and increasing lot size feels like a shortcut. But doubling risk does not erase the earlier loss. It raises the size of the next possible loss from a smaller capital base. If the strategy is temporarily out of regime, the account can move down the recovery curve even faster. A risk increase should require fresh evidence and a written rule. It should not be an emotional response to wanting the old balance back. A practical drawdown plan can begin with 3 separate limits. First, risk per trade controls the size of each individual error or normal loss. Second, a daily loss limit prevents one session, news event, or technical problem from becoming a major account event. Third, a total drawdown limit triggers a deeper review of the strategy and market conditions. These limits do different jobs. A daily stop is not proof that the system has failed, and a total stop should not be moved simply because the account is close to reaching it. A loss limit does not make trading safe. It creates a predefined decision point. At the daily threshold, new entries can stop while existing positions are handled according to the original rules. At the total threshold, the useful question is not, how can I win it back today? The useful questions are whether execution changed, whether the market regime changed, whether correlated exposure was overlooked, and whether the live behavior still matches the tested behavior. The limit buys time for analysis before urgency takes control of the next decision. The safest information comes gradually. A backtest checks the logic across historical data. A demo forward test checks timing, broker symbols, and basic execution without capital risk. A small live position reveals real spreads, slippage, swaps, and the emotional effect of money moving. Only after those stages behave reasonably should risk be increased in planned steps. Skipping directly from an optimized report to full size concentrates uncertainty at the exact moment the account has the least evidence. Deployment is not a single switch. It is a ladder, and every rung should answer a specific question. I also want to stress the drawdown before trusting the headline number. Increase spread and commission assumptions. Add reasonable slippage. Test different dates and symbols where appropriate. Reorder trade results with a Monte Carlo-style simulation to see how losing streaks can cluster. Then examine a scenario where drawdown is materially worse than the historical maximum. This does not predict the future. It reveals fragility. If a small change in cost or trade order turns a manageable decline into a severe one, the original risk setting may leave too little room for normal uncertainty. When comparing EAs, place net profit beside maximum balance drawdown, maximum equity drawdown, trade count, and recovery factor. In MetaTrader testing statistics, recovery factor is net profit divided by maximum balance drawdown in money terms. It is useful, but it is not a complete score. A high value from a small sample can still be unstable, and balance drawdown can understate floating stress. I also inspect the equity curve, the worst losing sequences, exposure time, and whether a small number of trades created most of the return. For a stop-based strategy, position size should come from the amount the account is allowed to lose, not from a favorite lot number. Start with current equity multiplied by the chosen risk percentage. Then divide that risk amount by the monetary value of the stop distance for the broker and symbol. Tick value, contract size, and currency conversion must be checked in the actual trading environment. Finally, cap the result for total portfolio exposure. A correct formula for one position can still create excessive risk when several related trades are open together. Eurus long, GBP long, and USD-CHF short may look like three separate positions, but all three can express a similar view against the US dollar. If they lose together, the account experiences a concentrated drawdown. The same issue appears when several EAs use related breakout or momentum logic. Diversification is not the number of charts or robot names. It is the degree to which their losses remain independent under stress. Before adding the individual risk percentages, group positions by shared currency, market driver, session, and strategy behavior. Before an EA starts, write 5 decisions. 1. Risk per trade or maximum lot. 2. Daily loss limit. 3. Total equity drawdown limit. 4. The conditions that cause a pause, such as abnormal spread, execution errors, or a major market shock. 5. The evidence required before scaling up again. If these decisions are made only after losses appear, they will be influenced by fear and the desire to recover. A written plan does not remove uncertainty, but it prevents every red day from creating a completely new risk policy. Here is an example structure, not a recommendation for every account. Risk 1% per trade, stop new entries after a 3% daily equity decline, cut risk in half after a 6% total decline, and pause for review at 10%. Resume only after execution is normal, the strategy still matches its tested behavior, and the restart conditions are documented. The exact numbers must fit the strategy, leverage, broker, capital, and the trader's tolerance. The important feature is the order. Define the response before the drawdown, not during it. The drawdown trap is simple arithmetic with serious consequences. Measure decline from the latest peak. Watch equity as well as balance. Treat historical maximum drawdown as an observation, not a guarantee. Stress the result, include correlated exposure, and choose risk that remains survivable through a losing sequence. There is no universal safe percentage, and no backtest can promise the next path. The goal is not to avoid every loss. It is to keep a normal loss from forcing an abnormal decision. If this was useful, subscribe to Atsushi Forex Lab for more practical MT5, EA testing, and risk management research.